On the last trading day of 2023, the Nifty closed at 21,731 and the Sensex at 72,240. It was a great year for the stock market people. Investment bankers made a ton of money through their bumper IPOs. Private equity firms and venture capitalists made exits from unicorns after booking huge profits. The money managers, the fund managers earned a lot because their assets under management grew, and so did their fees. What about retail investors? How much money did we make? Well, the Nifty gave close to 18% returns since the 1st of January 2023. So we must have made at least that much. But the real question is, what to expect from 2024? Is there going to be a big correction? If yes, what to do? When it comes to the stock market, you really cannot predict, but you can definitely prepare. So let's try to find out what preparations retail investors should make for 2024. Namaste and welcome to Retail Investing. So let's begin with the data which I personally find the most worrisome, and it is about the options market. The turnover of the options market compared to the turnover of the cash market is very high. And by the way, cash market is just a fancy name for the place where you buy your stocks from. You see, options are derivatives, which means they do not have any value of their own. They derive their value from the underlying assets, which are the stocks. Buying and selling of options involve a lot of leverage. So when the turnover of the options market is very high compared to the turnover of the cash market, it means the markets are getting over leveraged. And even SEBI is worried about this. Many new people who are coming to the stock market are getting directly into options trading, which is not only making them lose money, but also creating this over-leveraged situation. You definitely remember the global financial crisis of 2008. It all began in America when real estate derivatives known as collateralized debt obligations were traded at very high volumes. It ultimately led to the collapse of the real estate market, the collapse of banks, and the global financial crisis. Now, I don't expect such a big problem from the options market yet, but any problem from the options market has the potential to cause a big crash in the stock market. Now let's talk about three factors which could result in the continuation of the bull rally. In 2024, there are national elections both in India and in America. The Indian markets are pro-incumbency, which means the markets are likely to go up if the current government comes back to power. And based on the results of the recent assembly elections, it looks like the current government has high chances of coming back to power in 2024, and their pro-business policies are going to continue. The SIPs received by the mutual funds are showing growth month over month. And in addition to that, the FIIs are getting more and more interested in the Indian markets. And that is mainly because nobody likes to invest in China anymore. A lot of FII money is expected to enter India after a cut in interest rates, which takes us to the next point. Both the Reserve Bank and the American Central Bank have given indications of interest rate cuts in 2024. After interest rate cuts happen, there is high liquidity in the economic system. Borrowing becomes cheaper, which leads to higher consumption, and that generates more earnings for businesses. So these three positive points should definitely result in a continuous bull rally, right? Well, here is the catch. The markets are forward-looking. It means the markets have factored in all these future good news, and the current prices may already reflect all these events. If these events unfold as predicted, it could mean a phase of consolidation. And if these events don't unfold as predicted, there would be corrections. And that is exactly how the markets work. This is why I believe when it comes to the stock market, you cannot predict, but you can prepare. So let's have a look at the preparations. When the markets are at all-time highs, the most dangerous thing to do is momentum investing. Stock market momentum looks like a pyramid to me, where only those people gain who join early, and they want many more people to join. When new buyers stop coming to the market, the momentum ends and a crash happens. Buy high and sell higher sounds nice, but it doesn't work. I personally follow a strategy of putting money into my emergency fund when markets are at all-time highs. And when markets come down, I like to take money out from my emergency fund and buy good businesses at nice valuations. It is risky to play with your emergency fund, but I am willing to take this risk because I have a stable job. And by the way, your emergency fund should be your expenses of at least 6 months. So if the markets are scaring you right now, feel free to focus on your emergency fund. If you have been making SIPs into an index fund or any good mutual fund, you should definitely consider continuing it. Historical data shows us that people who continue doing their cost averaging without trying to time the market end up building huge portfolios in the long run. You see, you don't need a high IQ to be successful in the stock markets. What you need is a high EQ, which includes managing your emotions. Doing SIPs and cost averaging will reduce your emotional reactions to the daily drama that happens in the stock markets. This investing style works only for the long-term investor and can generate good results. But if you want great results, you will have to do something different, which takes us to the next point. If you have the skills to find individual stocks, market corrections may not even matter to you. Great stocks and their underlying businesses do not care for a bull market or a bear market. It might surprise you that there are stocks which did not even correct during the COVID crash. As a matter of fact, I talked about such a stock in a previous video, and the link of that video will be provided in the description. So please check that out. Always remember this fact that more money is lost in predicting crashes than in actual crashes. Pessimism and negativity are great news for the calm investor. Whether the bad news is about an impending crash or a current crash, just keep buying wonderful businesses at nice valuations and let the power of compounding change your life. That is my plan. Please let me know in the comment section what are your investing plans for 2024. If you got any clarity from this video, please like and share. And if you don't want to miss future videos like this one, just click on subscribe. Thank you for joining, and we will definitely meet again. Jai Hind.